Welcome to episode 1 of our educational series on passive real estate investing basics. Be sure to watch our series on 1031 exchanges and real estate taxation basics. We also encourage you to read our book, How to Retire from Being a Landlord, which you can order for free on our website or on Amazon.
In this module, we'll demystify the term cap rate, which is arguably the most fundamental metric used in the real estate investing industry. A capitalization rate, or cap rate, can be used in two different contexts, either broadly to describe a category of properties or narrowly to describe a specific property. Let's start with the broad usage. Reporters and analysts will often describe the average cap rate, or cap, for a given type of property in a given market. For example, they might say Class A office in the CBD is trading at a 3 cap.
Translated from broker speak, this means that all of the newer office buildings with modern amenities in the central business district that sold recently were purchased at an average price in which the projected 12 months of net operating income for each property was 3% of said price. Cap rates do not factor loan servicing, depreciation, or income taxes, and we'll talk more about NOI in our next episode.
A less nerdy way of expressing the broad use of cap rate is to say that for a given property type in a particular area, investors are expecting to receive a specific stream of income. Much like the mathematics of other financial instruments, differences in cap rates over time and geography are a function of interest rates, availability of investment capital, and the perceived risk associated with each property type.
Cap rates can be described locally or nationally for different sectors of real estate and for different classes. As another example, you might see a chart for historic cap rates of all Class B apartments in Nashville. If a 20-year-old suburban Nashville apartment complex produces a relatively stable income over time, but the cap rates for all similar properties in Davidson County go up, then the market value of the property almost certainly will go down. Cap rates, in other words, are the inverse of price.
All things being equal, if interest rates are rising, investor capital is declining, and perceived economic risk for a particular category of real estate is increasing, then the cap rate that investors will demand for such a property will increase. Unless the net operating income of a property is keeping up with rising cap rates, a property sold at a higher cap rate than when it was purchased will experience a loss in value. This is why we favor sectors such as multifamily and self-storage that offer the potential for increased rental revenue over time.
Now let's quickly look at the narrow use of cap rate. When a broker describes the cap rate of a particular property, they usually mean the projected 12-month net operating income of the property divided by its listing price or market value. These are often estimated numbers, as the property could ultimately trade at a different price, and the real income a year later may turn out to be higher or lower than the broker's pro forma.
If someone tells you a property is being offered at a cap rate of 4%, that means the seller's projected net operating income for the next 12 months equals 4% of the asking price. If you ultimately buy the property for a lower price, then the transaction cap rate will be higher, assuming the projected net operating income was accurate. Remember, cap rates are designed to help investors compare apples to apples, but they don't represent actual yields for any particular owner. Your yield on the cash invested is a function of the cap rate, but it's also adjusted for debt and income tax expenses that are unique to you.
Thank you for watching. Please be sure to watch our other education modules and visit our website at 1031capitalsolutions.com.